3% businesses in there, and now that you're looking at the whole thing, someone smart, new management, they ousted the guy who was in there anyway, and they say, hey, look, I don't want to be in that business, we'll sell it off, we'll liquidate it, we'll just, sell it, and we end up in a high ROA. So, that's first rush at it. She doesn't look that attractive, or at least the other one looks more attractive, and, all I'd say is both, and there's opportunities in both those areas. So, to the question, is this stuff still going on? Is it easy? It's a pretty big company. So, we have to go back 2 days, let's say, and then we have this thing where, actually, what is it, yesterday's paper? You're right. So it happened 2 days ago, but it was written up in yesterday's Wall Street Journal. You have Hewlett-Packard, board ousts Fiorina as CEO. And the big speculation is they're going to break up that merger. It was a big dispute when this compact HP came together, as you're familiar with. And, you had sort of a low-return computer business. And, I think it was David Packard. I think was someone in it. Is it David Packard? Yeah. Yeah. One of the directors, from the original founder, decided that, at the time of the merger, was against Carly Fiorina's purchase of Compaq, said, listen, we got one good business and one not so good business. We have this printer business, which is really not the printer business that's good. It's the supplying the ink to the printer business that's very good. But HP had huge market share in that business. They had the quality name. They had the distribution. They had a lot of good things going on in that business, and that was a high return on capital business. And the argument was, should Fiorina double down on the crummy business, and cut costs and make that more efficient? That bet kind of failed. And so the speculation now that Fiorina's gone is that they're going to undo that merger and split up the two businesses. So we have another potential spin-off here where you have a very good business with high market share in the printer business. Everyone will see that. And then you have the computer business. I don't know how it all plays out, but sort of it's an out-of-favor stock, really hasn't appreciated much in a lot of years. And so to partially answer the question, is it easy to make money? Huge market cap company, a lot of disarray, uncertainty here.
So for in this case, for example, what would your process be? Would you just wait as more information comes out and follow the paper, or would you start trying to make the business a little more?
Well, if I were your age, I would start now. I'm not as I would just say I look for more low-hanging fruit now, so that I'll look probably further along in the process. But there's a lot of money to be made now. In other words, this is still a big mess. Both of these things are a big mess. And what I would do, or what you should do, is to tear apart the company right now and get your first guess as to what the combined would be worth on a conservative basis. Sometimes you can do it, sometimes you can't. They haven't even put this on the table yet that they're going to spin this one off. So this is very early stage spin-off. This one was just announced. This one, though, to give you an idea how long it takes, they said this is going to take 1.5 years. And they said their cost saves are going to come over 5 years in the Sara Lee. So that tells me these guys are really slow and average. That's what this tells me. But this is how long this is going. So the other thing that tells me is, hey, room for improvement. They're firing the head guy, and they'll probably a good shot they'll get someone better considering how bad they are. And that brings up the other issue is Rich Cucina made that chart when he was in here last week. And we'll talk about him in a second. Open this thing. He had that graph, and whether you call it, this is average ROE or average price to book or whatever, and you have sort of this kind of graph where something is very low ROE now. What happens? What happens? How does it get back here? And we're starting towards that.
Like cost.
Well,
or generate bad business.
Things stink. Okay, things stink there. What do? You change stuff. You fire the guy. You sell a division. You close the factory. You cut costs. You do a lot of stuff, right? In other words, you just don't sit there and take it generally. And so the natural thing is to make changes. So, sometimes when I own a company, I'm actually, and I think it's really cheap, and it's being run badly, I'll say, I hope things get worse because I want these guys gone. And, if they're not getting rid of them now, in 3 or 6 months, if things continue to deteriorate, they won't have any choice but to get rid of these guys. And as long as I've left myself enough margin of safety to suffer through that, that's one of the benefits of having a long-term time horizon. If you're looking to make money, you're a money manager, you're looking to make money in the next 6 to 12 months, that's tough to live through. But if I'm getting a big discount and I'm looking at 3 years and saying, look, here's assets. They with this stuff going on without doing something for more than another 6 or 12 months. So there's an occasional time where I have a company, I'm rooting for things to get really bad, even though I still own it, because I've already put that into my stock price. Everyone knows it's really bad. And I just want some kind of change. I want some special situation to happen where they decide, I'm getting rid of that division, I'm getting rid of that manager, I'm closing that, I can't make it, I can't manufacture in the U.S. anymore, I'm going to outsource everything. Or whatever it might be, she was wrong, and we've known that for 3 years, but, time's up now, And so, these things are always percolating. There's always companies in trouble or things not going particularly well. Obviously, special situations like mergers or something like that, there are, the occasional guys who's good at empire building or, making strategic acquisitions, and you're in that mode and it's from a position of strength. But a lot of these things come from a position of weakness, a lot of these spin-offs. So, anyway, I'm just trying to give you an idea of how I look at these things. Hey, the 20% plus business, ROA business is interesting. Hey, the 11% business, they have, 15 brands. I don't know what's doing well and what's not. I mean, it's a big conglomerate. So that doesn't mean that much to me. That means there could be a huge disparity someplace, and I'm going to go look at this. And they're going to sell some and they're going to spin some off, so I don't know what I'm going to even end up with. So the question is when I start looking at these. If I looked at, I think Sarah Lee was at 23, I don't know, if I figured the two pieces were worth 36, I'd start looking at now. So how do I figure that out? I'm looking now. If I think they're worth maybe 27, I might like one or the other, I probably wouldn't play now. Okay, because that's not a big enough margin of safety for me. But so, and all the numbers I'm talking about are obviously guesses and, estimates. When someone says, this business is going to grow or something like that, I'm more skeptical of a claim like that rather than, let's say, a cost-cutting story. On the other hand, when someone says, I'm going to cut these costs and that, I discount that hugely. I mean, that strategy was basically the Fiorina strategy at Hewlett-Packard. It really wasn't the growth strategy. It was hey, we're going to combine these two and slash costs, and that's an easy one. They probably did slash costs, and the business got worse, more competitive anyway. I mean, it's a tough business. So, works both ways. None of these, I gave you the spin-off calendar from January, so none of these are on it. Here's one that was announced a few weeks ago you might have heard of, and this one is American Express. Okay, these are all large cap companies, and if you're an efficient market guy, I'm not going to look here. 30 analysts are looking at this. This is what they do terribly. This is what when some extraordinary event takes place to a company like this, they're used to following the company as they know it, and this is the type of thing that they're just not good at. They're not good at change. Generally, they're not good at staying the same either, but. They're particularly bad at, they'll suspend a rating or they'll, something really extraordinary event has taken place. They'll suspend a rating for a while, or they won't rate the thing, and or they won't analyze it anymore until the smoke is cleared, or whatever it might be. And, so there's an opportunity for you. Here, once again, this struck me. This was, the first day it came out from the Dow Jones Newswire, American Express, and a few things caught my eye with this. He added that the removal of AEFA, which is American Express Financial Advisors. Who knows what that business is?
It's basically a financial advisory business for middle-income Americans. And if you need to invest your retirement money, you go to an advisor and they say, put your money in these funds. And
these funds meaning these American Express?
Yes, although they say they don't do that, but they probably do.
that a lot. And they're good fund. He added that the removal of AEFA could allow American Express to hit the high end of its earnings target of 12 to 15% growth. We heard Rich Pizzino last week saying, gee, how many companies are going to grow at 12 to 15%? Now, I may, that particular division has been growing at 12 to 15%, for a long time. And it's a particularly great business. The travel business may go up and down with the economy, and so does the spending. But just to get 2-3% off every sale of pretty much everything is pretty good. Especially the economies of scale work pretty well, and the marginal dollars start flowing in pretty fast once you're established. Tough business to break into. A lot of good things about that business. Believe it or not, when I looked at this thing 10 years ago, when they were spinning off Lehman Brothers and those things, the good business really was the financial advisor business. That thing was growing like a juggernaut at 20% a year. So they kind of screwed that up. And now, they're sort of the poor relative of the main business. And then the next line it says 12 to 15% growth. Sounds interesting. He said the company may also hit the high end of its revised return on equity target of 28 to 30%. So that's a pretty darn good business. And then here, later on, I guess the fourth from bottom paragraph, it says if you look at AEFAs, the financial advisors' return on equity at about 11%, that's not terrific as a standalone company. All right, well, anyone see any opportunities here?
Well, it's the same thing as Sarah Lee. This part of the company is sort of taking the blame for all the scrubs the company's made over about the last 5 years. And so sort of once they get away from North American Express, there's a lot of opportunity for them to improve.
Right, they're screwing something up because they should have a very good business. Yeah.
I remember also that reading that the managers of the AEFA were going to stay with that company, stay with that business, which made me think that maybe they have the choice to stay in America, especially going to that business, but they probably think it's not such a bad business.
That's possible, and I imagine that they're pretty different businesses to some degree. So I would imagine that the managers would stay in this particular case.
Smaller.
Right, well, it's out of favor. It hasn't done well. I think it should have done well, especially during this period. It shouldn't be, as far as I can tell, a low return on equity business. When I was looking at last one, what struck me too was a number of things. But one, I always thought that was a pretty good business. And, I think some of the ways they screwed up was pushing people into the American Express products that weren't good and having those kind of conflicts. And I remember I met with this guy named Harvey Golub, who I think that's his name. He was the chairman of American Express about 10 years ago. And, was having a discussion with him. And we were discussing this business, and he was arguing basically market for a guy who's in financial planning, he was arguing market efficiency. Okay, markets are efficient, and with that, and this was right after our discussion. Let me just tell you, this is right after a discussion. I forgot the price, but let's say the price was at 40, and we went through all our metrics of why we thought the thing was worth 60 at the time, conservatively, and he agreed with everything we said. Yet he was arguing market efficiency on the other side, and I said, but look at your company. You're telling me, this is not a fair price for your company here. You're either not telling me what you really think, which is always possible, or, there's a disconnect. Like in the micro sense, you're saying that this is inefficiently priced. In the macro sense, though, you're saying stocks are efficiently priced and no one's better. And what does that lead to? That leads you to not caring or not feeling it's important. I know a lot of firms like this feel that, listen, we're not going to beat the market. This is the way the game plays. We're not going to beat the market. It's all bull. And therefore, what would that lead you to do? It would lead you not to hire the best people, because you think the people are fungible. You all stink. All right? None of you are going to do well. So I might as well hire the cheap guy because, I'm not going to pay for the best guy. What does the best guy mean? They're all going to do the same. So I think, that's a culture and an outlook. And I don't know if that led to hiring lousy people to manage their funds, and I'm sure there's some good ones in there, just in case anyone knows anyone. And I don't know, I haven't looked at each one individually, so I can't tell you, but I think that's a terrible attitude to have. I mean, you can have that opinion if you want, but I don't want you running a financial management company. And but things were going very well at that time, and that turned into a allocation business, which is an important part, how to allocate your resources. But I think that if you have low quality funds, that comes back to bite you in the end. And I think I'd like to say that's what happened here. I don't know, but that's possible. And so, room for improvement is one way you look at that. Shouldn't be a low return. I mean, just off the top of my head, shouldn't be a low return on equity business. I have to look at that. What parts of the business? Also, there should be different parts of the business. So I want to look and see which parts are earning a lot of money and which aren't. So that's interesting there. And you should be listening to me because your assignment for Wednesday is going to be go analyze this merger, American Express, this spin-off, okay, and come back. And I'll give you the quick and dirty of what I read from one report, and then you come back and tell me where you think opportunities and potential value is. Then I also looked, just for the heck of it, the return on equity target of 28 to 30% for the travel business, and the credit card business. I thought that was interesting because, part of that business is running up a balance sheet, and lending money to people, okay? And I'm not sure if they're getting a high return. If they told me a return on assets was going to be that, I'd be really excited because, you use a lot of, you pump up your assets pretty much. If you're going to lend money, you lend money to people at, I don't know what it is today, 8%, and you're borrowing at, 2 or 1 or whatever it might be. You get some free float in that business. You get a lot of good stuff. But let's just say your cost of capital is 2%, and people are paying you 8%. That's a pretty good business, but what you do is you borrow that money. So you balloon your balance sheet. So in other words, if people are borrowing $50 billion, then you borrow $50 billion at low rates. And so it looks like you have a huge asset size. So so you have a sort of a combination of business where you might have a business that has low return on assets but high return on equity because that's the way banks work, for instance. Where in this particular and then the other business where you just could have a high return on equity because you're just collecting those fees from sales, and after you reach a certain critical mass, you're just taking in money on the margin, which is pretty good. So, bottom line is, even on return on equity, there's different. I would like to see what's the difference between how much is in the financing business. What kind of returns on equity do they get there? Okay, it could be high, it could be low. I don't know. And then, what they're getting in the TRS, the travel-related service business, including the credit card, because they may be different. One may be getting 15%, and the other may be getting 40 or 50% returns on equity, and that's kind of interesting to me. Why is that interesting to me? Because I went and did a quick and dirty on what the two divisions earn, just reading one quick analyst report just to get a guess of what they're earning. And I think for this coming year, this particular analyst said, I think the travel-related service business, the good business, let's call it, is going to earn $2.50. And the quote-unquote bad business is going to earn 56 cents. So he gave a 16 multiple to the bad business, so 56 cents times 16, whatever worked out to, let's say, $9. Stock's at 55, by the way. So he gave that... So he said, I'll give that a value of $9, and then he just said, look, the good business is going to earn $2.50. I'm giving that a 20 multiple, that's 50. So I think the thing broke it up is worth around $59. Okay, the stock's at 55. So in one sense you can say that's not great. And in answer to Adam's question, well, when would you look at this? In this particular case, I think now is the time to look at this. Number one, I see opportunities in both areas. Okay, believe it or not, and so this is let's just call this a PD of 20. And I don't know if it's good, but I'm just telling you, when I read the paper, what do I see? And give you an idea. I don't know if any of this comes out to play, and so and I'm giving you sort of a context to do your work through Wednesday. But basically, this is a 20 PE he's giving to this business. And so my opportunities here, where he's giving us a 16 PE is, and it's earning 56 cents a share. My opportunity in this one is, I think maybe they could earn a lot more than 56 cents on this business. So the stick a multiple on pressed earnings isn't necessarily what this thing could be worth. Yet this isn't really the huge driver in value necessarily, because maybe $9 to 12 or 13 could be very good. $13.50 would be a 50% gain from here. That's good, but on a $55 stock, not the main driver, but something I might, after I do a little work, be willing to own. In other words, I'm willing to own it by paying $55 for the whole thing. Okay? So if I think $9 is probably conservative, then I'm probably thinking that, I really am paying $46 for here. So that here I pay $9. If I'm looking at buying the good business for $46, that's earning $2.50. Okay, so maybe it's down 18 times or whatever it is. Okay, but the point is, I might be willing to hold this anyway, so I might as well buy it now, because in effect I'm buying this business. Maybe I get a free kicker of $2, $3, $4 here or more. I don't know. So I'm just telling you my thought process. I don't know if this is really how it's going to play out. There's a billion shares or something like that, so I'm not that panicked that I have to figure this out tomorrow. And I'm hoping not that many people think like I'm thinking, and also have $40 billion to put to work in this thing. So I think I'll be all right. So anyway, so I think if I give a conservative value for this, all right, regardless, if I conclude that $9 is conservative, so what am I doing by paying $55? Now I can actually buy this. I can buy the parent, the nice, good business parent, and I'm just assuming I'm buying at 46, and I can take that as a conservative. Yes, I don't have to wait till it actually happens, because, in effect, I'm buying two things I might want to own. So where I said the opportunity here is in the earnings side, okay? In this one, believe it or not, being a cheap value investor, I think the opportunity may be in the PE side, okay? Because now you're unleashing a great, and I want to really look at that return on equity to see, how high one business is versus the financing business, which might be a large part. In the financing business, you could always, sell that off or whatever and take, get a high return on equity that way. I might want to keep that business. That's not it, but I just want to see what kind of business I own. And perhaps I own a 40 or 50% return on equity business, if I strip out the financial part. I don't really know. And so I don't know if 18's right. A number of years ago, and we'll probably analyze this later, is one of the best positions I ever took was, because I had looked at Duff & Phelps, which we looked at a year or two. I was sort of awake when Dun & Bradstreet was going to spin off Moody's. And Moody's was a business very similar to Duff & Phelps, which got 100% plus returns on equity, didn't require any capital spending to grow. And so what we did in that one, and we'll see the analysis, is we said, well, gee, one of the better investments made over the years was Coca-Cola. And so why don't we compare this, adjust for interest rates, this, that, the other thing. Let's compare when Buffett paid for Coca-Cola, and I was around at that time being old. And I remember thinking, gee, he's paying a lot for that. I think at the time it was 14 times earnings or something like that. And I said, gee, he's paying a lot for that thing, and I wonder what he sees. Anyway, that thing grew at huge rates of return over a long period of time after that. And so we would conclude that was really an excellent thing to do at that time, and even though it seemed like a relatively high multiple. So when we compared Moody's to Coca-Cola, there was no comparison. Moody's was actually a much, much better business. Because where Coke had to reinvest to get their growth, they had to reinvest 20% of their earnings back into the business. Moody's had to reinvest zero. Okay, so you could get the same growth, let's say, and possibly even more growth for no reinvestment. So actually, Moody's dollars were actually worth more earnings than Coke dollars were, because Coke dollars, to get their growth, you only had 80 cents on the dollar left after you got your growth. With Moody's, you got to keep the full dollar. So anyway, that just gives you an idea of why I might pay a lot for a good business, or a higher multiple than you might imagine. Something that gets a high return on capital. And so if this is truly growing 12 to 15% a year, I'll take you in a second, then I can project out 3-4 years what will this thing be earning if I believe that story after I get done analyzing things. And put a multiple on it. In other words, remember, if 10-year bond yields are 4%, and I could buy a business for $100 that's earning $4. Okay, then we're both getting a 4% return, except this one may be growing. Now, what I said to you was, yeah, that's true, but that analysis kind of breaks down when you get to very low interest rates, and I told you I would never use less than 6% for this. So when I'm comparing this, what I would say is, I may take, if you have a 20 PE, right, that would be the equivalent of $5 in earnings you're paying $100 for. So a 5% sort of current yield, all right? And let's say I have to compete with a 6% minimum 10-year bond yield, okay? This can compete if I think it's going to grow a lot, okay? And I might rather have that, depending on how solid I think the business is, how good the franchise is, how confident I am in my predictions. I may well want to have this. It's not to say I can't find other things that are cheaper than this, but that's my first analysis, is to compare it. Would I rather own this or a bond, a 10-year bond? And in Coke's case, in American Express case, I can already get this down to probably, 5.5%, 6% yield. And so I'm starting from there on something that's going to grow 12 to 15%. I want to see how much capital has to go into that business to get that growth. I want to see what kind of returns on capital are going into the business when I strip out the financial business. Okay?
How did you get to the growth, 12 to 15%?
I don't know. I read it in the Wall Street Journal. I'm not sure. I haven't done the work yet. I'd have to confirm.
Okay.
American Express gave that guidance.
Okay.
He added the removal of AEFA, and who is he? He is... I don't know, but it came from the company. Yeah, but it says the high end of its earnings target of 12 to 15%. So the company put out an earnings target of 12 to 15%. And so he's saying maybe, the high end, I guess, is 15. I don't know if that's right or anything. But I'm just telling you the formulation of a thesis is what I'm saying from reading this one article, okay, and then getting one report just to see how the breakdown of the earnings are. I'm just telling you, okay, here's the start of my thesis. All right, now I got to see if any of this is right and how it works and how I pick it apart and how I'm not just taking the numbers they gave me and how I want to break down the numbers to see how they got there. What's a good business, what's a bad business, or whatever. And it sounds like, that's a lot to figure out in about 40 seconds. Okay, but if you do hundreds of these, okay, over a period of years, those are the first things you think. You don't even have to be smart. You just have to sort of say, well, it worked this way this time, and then this time. And so what we're going to try to do in this class is really practice. Get as much experience as possible. That's why, I want you reading the Value Investors Club site. There is nothing like actually losing money yourself to get really good practice, but by reading as much as possible, that practice will be maybe less painful and you'll learn faster. I don't know, but that's the idea anyway. So your assignment for Wednesday would be to come back to me. I gave you the general thesis. Come back to me with some of your answers on, if any of this makes sense or what makes sense or what doesn't. Splitting up businesses, opportunities. And so here, like I said, I think the opportunity is more likely in the financial advisors in the earnings. And I think here, if you're going to be using 12 to 15% relevant earnings, or if that turns out to be true, multiple expansion could be the place. Because when I bought Moody's, it had a PE of 20, okay, which is not what I would normally do. But I thought the business was so good, and when I went through this simple analysis of this 6% thing, and I really ran through the numbers, I figured out, I really should probably be paying 30 times earnings for this thing. And the earnings are growing. So if those earnings are growing 50% a year, and you should get multiple expansion of 50%. Not that I would pay 30 times. Hopefully I'll find something cheaper, but fair price was that. And there are a lot of people with billions of dollars who will think that's a good deal, especially when their alternatives aren't that great. So I'm not saying, I'm going to run out and pay 30 times earnings for a lot of businesses, but I might even, in an extreme circumstances, and frankly, I've never found a better business than Moody's so far. Okay, I haven't. And so that would be the top of what I'd be looking at. But still, in that particular case, I looked at that. Now, American Express, I think, is potentially a really, really great business. I don't think it's Moody's, but I don't know yet. I don't know. I mean, I know it's not Moody's, but I don't know how good it is. I don't know if that 20. I don't know what that 28 to 30% means right now. I know it's very good. It's just a question of how good. I don't know if that's really 40 or 50 in the businesses I care about, rather than the financing business where it's not.
How do you think about the multiples in terms of whether it's worth 17 times or 21 times or?
Pretty much like I discussed right here.
6%
is a 16.66 PE, let's say, assuming no leverage. I generally think in pre-tax multiples because I'm looking at EBIT, but translated into a non-leveraged firm, everything else, you would say 6% EPS. 6% yield. So that would be the equivalent of earning on a $100 stock $6 a share, and you're paying 16.66. Yet, is that $6 growing? How confident I am that it's growing? How long do I think it's growing? How good is that franchise? How long lasting is it? And then I compare it to this. Then I compare it to my other alternatives. But the first thing I'll do is compare it to this to try to come up with what I think is a fair multiple. Now, the beautiful thing about being a value investor combined with trying to value businesses is most businesses I can't figure that out. I just can't. So I'll skip those. So that's number one. Number two, when I can't figure it out and think I have a pretty good view, I'm only going to do it when I have so much room. I think it's worth $10 and I can buy it for 5 or 6. Or it's going to be worth $10 in 2 years and I can buy it for 5 or 6 now. Something like that. I think, and if I'm wrong, so I kind of break even is the way I look at it. So I don't measure risk by volatility. I'll measure risk by, how much money I'm going to lose. Okay, and how confident I am that I'm not going to lose money, even if these 10 things go wrong, or I'm wrong about these 6 things, or whatever it might be. I'll measure it by, am I going to lose money? And so, it's like flipping a coin, saying, $5 if it's heads, and I don't lose anything if it's tails. You flip that coin a lot, right? So that's what I'm trying to set up in my investments.
You mentioned adjusting for interest rates when you're comparing Coke to Moody's to compare the valuations.
Yeah.
How did you go about that?
Well, what I said was that we were going to discuss that in a later class.
Oh, sorry.
So, and it's not a science, even though it, mathematically could be. I took broad brushstrokes to answer that question.
It seems in the book that when you discuss a situation like this, that
you pay attention to that book.
It's a good read. I'm a writer. I like the. You seem to suggest you start looking at a company like this, but it seems like you really didn't make a decision until you actually set a proxy. Is that not true? Or sometimes you make a decision at this stage, or usually it almost always wait for the proxy.
You're very helpful. All right, so let's go. Let's go to our videotape here. Let's go to page 1. Flip over the first 2 pages, which are the things that maybe you can pick some of your. This is a spin-off calendar from January. Some of the spin-offs didn't have any of these 3 in it when you're doing your paper. The next thing is something we'll talk about. These are companies that are own stock in other bits and pieces. In other words, these are parent companies that own stakes in other publicly traded equities that we'll talk about next when you turn the page to see this here's the example that we had in the book, and we'll just go over the details of the timing in answer to Adam's question. The first announcement of this year is, similar to what we've just read in the paper in the last 3 days. Big companies, everyone's looking. This announcement came out in September of 1992. Okay, and it says, basically, this came out September 29th, and what he said is, what we're going to do is sell. We own. Sears at that time had two big subsidiaries. One was Dean Witter and the Discover card included in that division. And the other big division they had was Allstate, in addition to the retailer that everyone knows about. So on September 29th, they announced that we're going to sell 20% stake in our Dean Witter to the public. Why would they sell 20% rather than just spin it off?
Get a valuation.
Pardon me?
Yeah.
Why do they care about evaluation? They're spinning it off. There's what they said they're going to do with Dean Witter is they're going to spin off. They're going to sell 20% of Dean Witter and then they're going to spin off the other 80% of Dean Witter. All right. So they owned 100% of Dean Witter Discover. What they said they're going to do is they're going to sell 20% to the public, and they're going to spin off the other 80% shares that they own. Okay. So one of the answers was, well, they want to establish a value for the spin-off. But if you're spinning off the whole thing, what do you care? The shareholders are getting it all. Is there another reason why you would sell 20% first?
Tax-related something?
No, but it's tax-related in this sense. You can't sell more than 20% and still have a tax-free spin-off. Okay? And collect. I think the general rule is that if you own 80% of something, you can tap their cash flow without, an extra tax step. Okay? And so you wouldn't sell more than 20% if you were going to keep 80%. But why would you sell 20%?
Maybe if you want to buy something, like your shareholders.
You're pretty crafty, but no.
Just to get the cash.
There you go. You want money. When you spin off something, usually managers, the reason they keep buying stuff is because they want to expand their domain. The reason you're spinning off stuff generally is because it didn't work out, or you're not getting the value in the stock market, or something's not going right. And so that's kind of a painful thing to do, to get rid of assets that you are under control on. You don't stay chairman and CEO of both. You have to pick one, and now your domain is considerably smaller. So you might want to get rid of it, but keep some of the cash, value of it. So if you sell 20%, you get that cash. So rather than just giving it straight to the shareholders, instead of giving it to the shareholders, you take back 20% cash. So that's just one reason why you would do it, to get rid of it, but keep some of the value from it. So they announced that they were going to do that. They were going to first sell 20% to the public in a public offering, and then a few months later they were going to spin off the other 80%. So you're going to get the whole value for that. And then also they announced that they're going to sell 20% of Allstate to the public, but they're going to keep the other 80%. Now, having been in business for a while, when they're doing this and they're selling 20% of Dean Witter, and then they're going to spin off the other 80%, and then they announce, well, we're going to sell 20% of Allstate Insurance, and then they say, Sears said it will continue to own 80% or more of Allstate and has no intention of disposing of this interest. That means that they're going to dispose of that interest. Because there's no other logic to that move. I mean, once you sort of can't be half pregnant here. They're dead. So, and that you can only get really from hanging out for a while and reading corporate speak. Okay. What it says is we're going to try to hold on to this, but there's no way that's happening. So, okay.
One question. Just what about some of the internet spin-offs, like Barnes & Noble, spinning off BarnesandNoble.com, and then eventually they did hang on to their stake and bring it back in? I mean, do you see that some companies do that, or just trying to take advantage of, market?
Right. That particular was an interesting situation where they BarnesandNoble.com, even though it wasn't making any money and losing money, they could do a public offering and sell 20%, right, at some ridiculous internet price at the time. So they took advantage of that. But I think because for strategic reasons, in other words, Sears is a department store. Allstate's an insurance company. Dean Witter, Discover is a brokerage firm, credit card company. And so there's no strategic reason to hold on to it. In that particular case, a lot of reasons. One, to take advantage of the internet bubble. And two, you can imagine that there's a strategic reason for a bricks and mortar bookseller to hold on to their internet bookseller. So I think there was the strategic reason on both ends why they sold off the piece and why they kept control of it at that time. So.
Last question. This may be asking you to read too much into this, but they have no problem admitting they're going to spin off Dean Witter. Why, or what's their incentive to say that we have no intention of ever spinning?
Oh, because they don't want to.
They don't want to, but they're
They
probably
will.
just going to have to.
Yeah, I'm just
Okay.
reading. Yeah. You know, I suppose if they get the value out of the stock, there'd be incredible pressure. You know, in those days, being from Sears was a euphemism for being a loser. You know, I mean, basically, I mean, they're really the worst of the worst. So under pressure, they do this, and they're not going to be able to hang on to as much as they want to hold those assets. I did not think at that time. I assumed that I was eventually going to get that. I may have to wait around for a couple of years, but since my horizon is, 3 years, no problem. Now, I did not, to let you know, when this came out, I didn't do anything. Okay? This came out in September 92. So now, you move to April 93. Me still asleep at the switch, even though I've been doing this for 10, 12 years already at this time. Still asleep at the switch. And we see that there's an article in Chicago Sun-Times, but every other paper, that they're getting ready to, let's see. I guess they did the public offering in Dean Witter. And now already, so I missed that again, and now they're getting ready to spin off the other 80%. And what you get is, for every share of Sears you own, if you're a shareholder of Sears, you'll get 0.4 shares of Dean Witter. So if Dean Witter is at 35, and you get 0.4 shares, you're going to get roughly $14 for every share of Sears that you own. Since Sears at that time was at $53, you could quickly do the analysis, is that you could either short the Dean Witter that was out there and create the rest of whatever Sears was for $39, or you could just wait for your distribution and sell it off when you're done, and take the risk where Dean Witter moves in the interim before you get it, and get roughly $14. Not exactly $14, but so yes.
Can you do that math again?
Sure. If you own one share of Sears, okay, and Sears had, I think at the time, let's just call it 440 million shares outstanding. Okay? Sears, let's just say, because I don't know the exact number, owned 176. So let's say they owned 176 million shares of Dean Witter. Okay? They spun off 20%. The 80% share of Dean Witter was 176 million shares of Dean Witter. Okay? That's what Sears owns. So if they said, hey, we're going to spin off our shares of Dean Witter and give them to you, when they get done spinning them off, if you own one share of Sears, okay, that means that for every share of Sears you own 0.4 shares of Dean Witter. Okay? In other words, if there are 440 million shares outstanding, and you're going to get 176 million, they're going to distribute 176 million shares of Dean Witter, that works out to each share of Sears is going to be getting, each owner of a share of Sears is going to get 0.4 shares of Dean Witter. And then what you'll own, now Sears was trading at 53. 0.4 shares of Dean Witter is 0.4 times 35, or wherever it was, is $14. So that means that whatever's left in Sears, which is basically the retailer and the insurance company, Allstate, you're paying $39 for effectively. Are we good?
Yeah, when you were talking about it, you could short the outstanding.
Okay. Well, you had Dean Witter trading at 35. So what you could do, let's say they announce that this is taking place. I think this is going to, they're announcing this is going to take place in a few months, let's just say. Okay? And this is April. And you say, you know what? I want to own the rest of Sears and Allstate, but I really don't want to own Dean Witter at $35 a share. That seems pricey to me. So what I'm going to do, since I know in a couple months I'll buy a share of Sears, and since I know in a couple months I'm going to be getting 0.4 shares of Dean Witter from my Sears stake, right? It's like a dividend, right? Then if I short 0.4 shares for every share I own, I'll be effectively taking in $14. Now, if it goes up, I will have been worse off for doing that. If it goes down, I will be better off. But my assumption is either I don't have an opinion on Dean Witter, or it's overpriced, or whatever. Usually, it's I don't have an opinion on Dean Witter, and I do have an opinion on the remaining company. Okay? Then I'll do that. So the point of this exercise, though, so that's April. They announced, we're going to be spinning off this point. You're going to get 0.4 shares. You pretty much knew that already. But now they're announcing, hey, it's in action. I know we said this in September. Now it's April. We're getting our act together and we're doing this thing. So the next page is when they fess up to the fact that not only are they going to, page 4, I guess this is, they've already made the decision to, the headline is Allstate offering scheduled for early June, Goldman. All right? So Goldman Sachs is doing the offering for Allstate, and they're going to sell 78 million shares of Allstate. Okay? I think I got my numbers wrong. But anyway, they're going to sell 78 million shares of Allstate. They tell you the range that they're expecting, not that that's guaranteed in any way, because this is just May. 24 to 27. Upon completion of the offering, Sears will indirectly own about 82.1% of the outstanding common stock. Now, they also announced at this time that they're going to spin off the rest of Allstate also. Okay? So they fessed up to what they didn't want to do in September, and they're going to go do that. So now what happens in June? Oh, by the way, I still haven't bought the stock yet. Okay? I haven't even looked at this situation. Okay? So I'm going to lose it. Okay, so now, Allstate. Just tells you don't have to be that good to make money. So here, we'll see on this example. Now, Allstate is selling 78.5 million shares. Sears is selling 78.5 million shares of Allstate to the public. And you see the per share price is $27 in this offering. And this is taking place towards the end of June, like June 20-something. And that will leave them with whatever the inverse is. I think it was about 343 million shares. And what was great about this for someone who's not a math wizard is that the stock in Allstate, the 82% of Allstate that Sears was going to keep, was equal to the number of shares of Sears there were. So in other words, what you were left with once they did this offering was one share of Allstate. Okay? So you still haven't got your Dean Witter yet. That's happening in July. Okay? You're going to get 0.4 shares of Dean Witter and 1 share of Allstate.
For each share of Sears?
For each share of Sears. You're going to get distributed 1 share of Allstate and 0.4 shares of Dean Witter. I'm still not following this, though. So there it is. Directors of Sears, or it says June 18th, directors of Sears Roebuck Friday approved the spinoff of the company's 80% interest in Dean Witter, Discover, to Sears shareholders. Okay, so they're spinning off that 80%, which is equal to about 1 share for every share of Sears you own. So there's the announcement, June 18th. Completely missed this also. Luckily, on page 8, we have, this is an interview with Michael Price and Barron's, not exactly hidden, July 5th. I think my edge here was that, it was probably a holiday weekend and no one was reading, I don't know. So, I guess the only thing I can think of, because it was announced in September, now we're in July. Okay. And I see this interview with Michael Price, who I think is a smart guy, so, when he's written up, I skim through Barron's, if I see somebody that I think is smart, I'll read about them. And so I'm reading this interview, and he says, it's highlighted on the left, with those 2 black lines. It says, Sears, on the other hand, has gone faster than expected, both in terms of its sale of Allstate and its spin-off of the rest of Dean Witter. Sears will be left with the retailer. And at $54, a share, it includes one share of Allstate, which is at 28, all right? Because Goldman Sachs did the offering, stock's now selling at 28. So he's saying Sears is at $54. Now he's saying, gee, for that $54, that includes one share of Allstate, which is worth $28 a share. Following that, right? Makes it pretty clear. So that leaves $26. Then you get 0.4 shares of Dean Witter, which is worth $15. So whatever Dean Witter's at that time, probably 37 or whatever the number has to be, it would be $15. So 0.4 shares of Dean Witter, you're about to get $15. So that adds up to $43. That leaves $10 or $11. But he says, if you look at what's consisting of the $10 or $11, once you get rid of Allstate and Allstate and Dean Witter, he says, gee, about 2 or 3 of that is Sears Mexico and Sears Canada. That leaves about $8. Coldwell Banker, which is a broker, a real estate broker, Sears owned that also. That's worth $2 or $3. So that leaves about $5 a share, or a market cap of $1.5 billion on $27 billion in sales. Now, and then he says, the new management seems very focused. It's an almost debt-free retailer with huge real estate opportunities. Part of this whole analysis, when you subtract these values and everything else, what are you paying for the rest? You have to work out the debt. Okay? In this particular case, there was no debt on the retailer. So truly, you had a market cap or an EV of $1.5 billion, sales of $27 billion. It's about 6% on the dollar of sales. Okay? So this is when I finally wake up. There were, 20 announcements. Big. This is not a hidden thing, Sears. It's been in the papers a lot. They're doing all kinds of offerings. Dean Witter's not unknown. Allstate's very big name. I'm sleeping this whole time. Okay? Now, and I do spin-offs for a living. That's pretty sad, right? So, so nevertheless, I say, gee, that looks good. So, and unbelievably, I guess I'm the only one who reads about my price in Barron's, because what I was able to do after reading this was, if you turn to page 10, I guess you're on that little circle, I took out an S&P tear sheet. We used to use these before computers, or the internet, or whatever. And I think we actually had computers back then. But, and I just did a quick and dirty. And if I look on page 11, I see that last year, JCPenney, and I categorized this as a crummy retailer. And I categorized Sears as kind of a crummy retailer. JCPenney had about $19 billion in sales. According to the front of this thing, the stock was around 41. There were 235 million shares and some preferred and all that stuff, but let's just call it 10 billion. It was actually higher. And so this is, whatever it is, 55% of sales. Just as a quick and dirty. See what, compare one crummy, forget about earnings and everything else. Just, I'm looking, I don't want to work too hard. This is, it's not fun. So, Michael Price is saying 6% on sales. And then I look at JCPenney, not even including their debt, okay, which is $2.5 billion. I don't know if that's credit cards or what. So, I don't, let's just exclude that without their debt, okay. This is called their price sales. If you added the debt in, obviously it's trading even a higher price than I'm saying, percentage of sales, but I'm not sure if that's credit card. So, right here I see right away 55% of sales. And here we have 5 and it's probably like, what does this work out to? 9.5 divided by 27. Anyone have that?
So 5.5%.
Yeah, 5.5% sales. When you throw in the debt and whatever, So, all right, so 5.5% sales. So I'm saying, gee, this is priced 10 times. So I remember the 10 times, so that's why 5.5%, right? This is trading on at least a price sales basis 10 times higher. They both stink. I mean, JCPenney is no great shape. Okay? You have to compare earnings. You have to do a lot of stuff other than this quick and dirty. But even if Sears wasn't earning as much as JCPenney, I don't remember the answer to that, you would say, gee, they're both sort of hitting the same markets, and these guys have this kind of valuation. Maybe it's overvalued, but 5.5% means maybe something could be fixed here. Or maybe this is just way too cheap, or I don't know. But it's 1/10 the price of JCPenney on that metric. So, a few weeks later, they spin off both these things. And I'm able, what happens is I think they spin off the Dean Witter, and then I short out the Allstate and create a spread. And then I get the Allstate back in a couple months, or a month or two. So for $5, as Michael Price said, I was getting something that I think could be worth $50. Just quick and dirty. I think I probably did a little more work than that, but that's sort of how it came out. And, in the next, I'd say it took 2 months, but this thing, that $5 went to 30, 2 months after I missed everything and just read it, my price. And eventually it did go to 50. So, this was, so I guess before I give you a break, how the heck did that happen? This thing's been out for months. This thing's been out for months, right? I missed it September. I missed it March. I missed it April. I missed the offering in June. I missed the Dean Witter offering. I missed the announcement of the spinoff. Michael Price lays the whole thing out for the entire world. I am then able, over the next 2 weeks, to buy whatever I want. Okay? And I should go back and have that conversation with Harvey Golub, right, about efficient markets. But the question is, how is that even possible? How are we going to make money in American Express, Hewlett Packard, Sara Lee? The front page of the Wall Street Journal for a long time. They're going to do these things now. Hewlett Packard's, Sara Lee's not happening for a year and a half, they claim. Hewlett Packard hasn't even been announced yet. It's going to happen, but they haven't announced it yet. And American Express is taking their sweet time too. Okay? And so there's plenty of time for everyone to find it. And, this was front page news back when I found this thing at Sears, and this stuff keeps happening. So the question is, how is that possible? How is that possible? And this is, Michael Price laid it out. Like Barron's to say, it wasn't written in, Swahili news or something. And it was like, it was, written in Barron's, which, financial guys read, sort of, guys who manage money and stuff. Not to mention the Wall Street Journal and every other publication. So I'm just kind of curious,
I'd have to say that because it's back to that.
Right, that would be one answer.
Yeah. And
I'm going to make a lot of money from one of those three. I'm not telling you which one. When I wrote one of the questions was, you wrote the book, you ruined it for everybody, that's things, blah, blah, blah. Well, you know what? The first year after I wrote the book, spin-offs did crummy. Now they've done incredibly well. There was, it's just things don't change. This guy wrote this book in 1958. He didn't ruin it for anybody. I think I'm the only one who bought a copy. It took me 40 years. But this stuff's been around. And it was around then. There were plenty of guys looking at this stuff, and this was Sears. We're not talking about obscure spin-offs, okay? I would agree with your argument if we're talking about obscure spin-offs, not on the front page of the Wall Street Journal, not huge market caps, especially for that time. This was a huge market. Very high-profile businesses. Michael Price, pretty high-profile guy at the time. It wasn't really like the Stone Age, as much as you might think it was. Things haven't, and I'm telling you that I'm not worried about making money doing this stuff. So I just was curious what your explanation for why this, we do this stuff.
I mean, it's sort of a lengthy time process for a lot of investors. People lose focus on what actually is going on in the company.
Now, Michael Price wrote this up on July 5th, and so I had 2 weeks to buy this thing before.
I think there's some merit to the argument that you probably got help by it being in Barron's over July 4th weekend.
I didn't buy it yet. It hurt me. I wish you just called me. But I'm making it sound too stupidly easy, right?
It's a sort of a hiding in plain sight sort of thing that everybody knows. American Express Financial Advisors is a crappy business. Why would anyone want to own it? Don't bother, and so nobody bothers.
Could be. That's part of it. I think it's messy. An institution's not going to, want to own this piece, that piece. I like Dean Witter, I don't like this. It's messy.
But you don't think, that there's plenty of hedge funds could go around to take that risk and create spread shorting the stock?
Well, yeah, I had short for a week or two. Yeah, but
it's not that institutions don't want to own it, I wouldn't say. Right now, there's plenty of institutions that...
Okay, so you're saying...
That would, at least potentially.
Okay, well, there were plenty of institutions back then, and there are plenty of institutions now, and I'm telling you, after the first year after I wrote the book, Spinoff's done great. Isn't it good, though?
How did the other two spun-off companies fare? Because maybe it's just difficult to value the three together.
Well, I answer this a lot in the class. I don't know and I don't care. I created this thing for $5 and it went to 30 in 2 months, so that was good. But they both actually, to my knowledge, didn't cave in any way. It wasn't like some Palm 3Com thing that had a short window or something like that. This was really oh, by the way, I wrote the book. I did Palm 3Com, and I created, I did the same thing. I bought Palm and I shorted, I bought 3Com and I shorted Palm. And I was able to own the rest of 3Com for negative $23, which I thought was a big deal. Maybe $23 a cake. The rest, I thought that was really good. So that wasn't that long ago, but that was really, inexplicable. Well, I clearly can't explain it. So anyway, bottom line is, this stuff happens. Okay, this is a particularly blatant one, but these are blatant ones too, and there's going to be a lot of money to be made. And I tried to help you in the beginning, say, well, everyone's not going to really be looking at it that way. Where's my opportunity here? Where's my opportunity there? And if you own 30, 40, 50 stocks, you're not going to spend a lot of time really analyzing the messy ones and this and that. There are plenty of hedge funds out there, but they're all subject to the same, biases and they do what their friend's doing or whatever it is. They don't, it is somewhat hiding in plain sight. It is that it's complicated. It is that perhaps you have to think about it in a little different way, and we have to practice that. And I'm better at it than I was 20 years ago, and I've seen a lot of things, and the experience is good. But Michael Price, laid it out for me. I even missed it, or was too lazy to look at it, or whatever it might be. And here, a very easy one. And despite what anyone tells you, obviously I'm showing you one of the better ones, but this stuff's out there. And just, last 3 days, tons of fodder for this kind of analysis. And there are different times to get in. There's plenty of time to get in. Sometimes you should get in early because the split up is a good thing, and you have to analyze that quickly. So I would look at this and say, you know what I really want to own, if you're kind of screwed, if you wanted to own, I took it off the board, but if you want to own American Express Financial Advisors, and it's the $9 piece of the $55 stock, you got to wait. Because you don't want to take on that big $46 thing that you can't hedge out in exchange to get a $9 thing, bless you, that you think is cheap. But, like I said, I might be interested in the main business. Don't know yet. You're going to tell me on Wednesday. But I might be interested in the main business. And if I think that $9 is pretty conservative for the other one, I may be able to play right now. Okay, I may be able to buy this thing right now at $55 because I'm not taking on that huge elephant with me. I'm actually buying a piece of something that may be cheap, and I don't really think it's expensive. I don't know if that's the case, Steve.
I just wanted to understand your trading strategy. You bought after Dean Witter was dispersed?
I bought, I think, a week before it was dispersed. I shorted it out, but you didn't have to.
So,
in this particular case, let me explain something.
You sure once it's out.
No, I shorted it the week before it was spun off and covered my short within a week. However, you didn't have to do any of that fancy stuff. Because, number one, if you looked at Allstate, and Dean Witter you're getting in a week. Allstate you're getting in a month or two. Now, Allstate was a very stodgy insurance company, not trading in particularly high value. Okay? In other words, it was a very average to low price at that time. It was trading. It was trading in line with all the other guys. I didn't think it was expensive. There was really no reason to hedge it other than this was so good. I wanted to buy so much that I didn't really want to take the Allstate risk with it. But just a regular shareholder could be like the American Express. And to me, it was like, look, I'm willing to buy American Express now if I like if I like the travel-related service business, because the good business, because that's a big chunk. And as long as I feel pretty good that that $9 is going to be worth 8 or 10, then that's not going to be the driver of whether I want to own this. And I wouldn't even short any. If I could short out the 20% that's trading, I wouldn't.
So you borrowed one Allstate and 0.4 of Dean Witter, and you bought Sears.
And then I got the 0.4 Dean Witter back in 1 week. And then I got the Allstate back in 2 months. And actually, what I did was, so that I could buy a lot, which was something that was less available then, I did a derivative trade where I just laid out the $5. And, it was long and assumed that the two. So I just literally invested $5 in this.
I guess that's where I was getting at, because, what was the rationale if one you were going to get in a week, the other one you were going to get in 2 months?
Well, I only
buy the Sears. I just wanted to know why you.
Why? Because I did not think if I was long Sears and short Allstate that I was really taking any risk, since I'm getting my Allstate shares. I'm taking the 2 months risk as it, not even risk, but just 2 months till I got the shares to cover my short. So I wanted to buy a lot, and I didn't have enough money. So I wanted to just lay out my $5 rather than 33, even though I didn't. Even though I thought there was $30-40 a room in this thing. So as an individual investor, you still could have, taken huge advantage of this thing.
You mentioned that you shorted the Allstate and the Dean Witter before their public offering.
No, not before their public offering. Before they was 80% was spun off. After the public offering.
So you still can borrow this up.
Yeah, there were hundreds and hundreds of millions of shares outstanding.
Okay, so that was not tight.
That was not tight.
What percent of your portfolio are you putting in a position like this when you say, well, this is a big upside?
Yeah. We'll talk about portfolio management. I'm on the.
You only have a few positions, so obviously.
Yeah, I'm on the scale. I'm on the extreme scale of, gee, I can make 10 times my money. How much should I put in here? And then, whatever model you throw that into, it's like a lot, right? You want to put a big percent of your portfolio in there. So I don't remember the specific amount, but it was, huge. Anyway, I'll give you come back in 10 after, and I'll let you go.